Section 5:1 Introduction to Alpha, Practical Examples and Case Studies. 5.1 Alpha Analysis of Investment Funds, Evaluating the alpha of different investment strategies, such as value investing or momentum investing, involves assessing their ability to consistently generate excess returns relative to an appropriate benchmark. Here's a general approach to evaluating alpha in different investment strategies. Define the strategy. Clearly define the investment strategy under consideration, such as value investing or momentum investing. Understand the underlying principles, criteria, or rules that guide the strategy's investment decisions. Select a benchmark. Choose an appropriate benchmark that represents the strategy's target market or asset class. The benchmark should closely reflect the strategy's risk and return characteristics. Common benchmarks for equity strategies include broad market indices like the S&P 500 or specific sector indices. Calculate alpha. Calculate the alpha of the investment strategy by comparing its performance against the selected benchmark. Alpha represents the strategy's excess return, above or below the benchmark's return, after accounting for the systematic risk captured by the benchmark. The calculation typically involves regression analysis or other quantitative methods. Assess alpha significance. Evaluate the statistical significance of the calculated alpha. Determine whether the alpha is statistically different from zero, indicating a potential skill in generating excess returns. Statistical techniques, such as t-tests or p-values, can help assess the significance of the alpha. Consider risk-adjusted performance. Evaluate the strategy's risk-adjusted performance in addition to alpha. Risk-adjusted measures, such as the Sharpe ratio, Sortino ratio, or information ratio, assess the strategy's ability to generate excess returns relative to the level of risk taken. A positive alpha alone does not guarantee superior risk-adjusted performance. Analyze consistency and persistence. Assess the consistency and persistence of the strategy's alpha over time. Evaluate the strategy's performance across different market cycles, economic environments, and time horizons. Look for evidence of sustained alpha generation rather than relying solely on short-term results. Compare to peers and benchmarks. Compare the alpha of the investment strategy to other strategies within the same investment style or asset class. This comparison helps assess whether the strategy's alpha is unique or if it is similar to what other investors in the same space are achieving. Evaluate how the strategy's alpha compares to alternative investment opportunities. Consider qualitative factors. In addition to quantitative analysis, consider qualitative factors that may impact the strategy's alpha, such as the manager's experience, expertise, and track record. Qualitative assessments help gauge the credibility and competence of the strategy's implementation. It's important to note that the evaluation of alpha in different investment strategies is not a one-size-fits-all approach. Each strategy may have its own unique characteristics and factors to consider. Additionally, the evaluation should be done with a comprehensive understanding of the strategy, considering its limitations, risks, and potential biases. Alpha analysis can provide valuable insights that inform investment decision-making in several ways. Identifying skilled investment managers. Alpha analysis helps identify investment managers who have demonstrated the ability to consistently generate excess returns relative to a benchmark. Managers with positive and statistically significant alpha values indicate a potential skill in identifying investment opportunities or managing portfolios effectively. This information can guide the selection of skilled managers for investment allocations. Comparing investment strategies. Alpha analysis allows for a comparison of different investment strategies or approaches. By evaluating the alpha of various strategies, investors can assess their potential for generating excess returns and select strategies that align with their investment objectives, risk tolerance, and market expectations. Assessing risk-adjusted performance. Alpha analysis, in conjunction with risk-adjusted performance measures such as the Sharpe ratio or information ratio, provides a comprehensive assessment of investment performance. It considers both the level of excess returns generated and the risk taken to achieve those returns. This information helps investors evaluate the trade-off between risk and return and make informed decisions that suit their risk preferences. Validating investment thesis. Alpha analysis can help validate investment theses or strategies by quantifying their effectiveness in generating excess returns. If an investment thesis or strategy aligns with a positive and significant alpha, it provides support for the thesis and strengthens confidence in its potential for success. Supporting asset allocation decisions. Alpha analysis can guide asset allocation decisions by assessing the potential contribution of different investment strategies to a portfolio's overall returns. Strategies with positive alpha values may warrant a higher allocation within the portfolio, while strategies with negative or lower alpha values may be reconsidered or allocated a smaller portion. Monitoring manager performance. Alpha analysis facilitates ongoing monitoring of investment manager performance. By regularly evaluating alpha values over time, investors can assess the consistency and persistence of a manager's ability to generate excess returns. This information helps identify changes in manager performance and informs decisions regarding the continued allocation of capital to the manager. Guiding investment research. Alpha analysis can guide investment research efforts by identifying factors or variables that contribute significantly to alpha generation. By understanding the drivers of alpha, investors can focus their research on those specific areas, seeking to uncover additional sources of excess returns or refine investment strategies. Overall, alpha analysis provides a quantitative framework for evaluating investment performance and making informed investment decisions. By considering alpha alongside other relevant factors and conducting comprehensive due diligence, investors can enhance their understanding of investment opportunities, optimize portfolio construction, and improve the likelihood of achieving their investment objectives.